waste. They called it fraud, I called it faith. I saw the heat before the shape. They wanted numbers, I offered skin, and told the data to confess within. Your fluid sang, they told me things no priest, no doctor ever brings. Your doubt was holy, your climax true. So tell me what's more human than what I do. I see you bleed, but darling, I just read the need. I felt the quake. Not every saint gets to be opaque. You gave, I named, I burned, I basted, but not a drop was wasted.
Today, we are giving your entire financial market fantasy the ultimate Python-powered blow-up. Our mission, should you choose to accept it, is to marry the beautiful, absolute chaos of the markets with the sickening precision of code.
It's a match made in heaven. Or, a very specific corner of hell.
Exactly. Think of Python as your ultimate drag mother, taking that messy raw data and beating its face for the gods until it's structured, snatched, and ready for the runway.
And for you, the learner, we have pulled together a truly wild stack of sources. This isn't just a cute little coding class.
Oh no.
We're getting into everything. High-speed data science, the drama of crypto, banking realness, even market microstructure. And it's all through the lens of Python and, crucially, data quality.
Yes, quality control, because we are not putting any busted reads out into the world. Now, before we can even start serving looks,
Oh, hey, I think our listeners got something to say.
Hey guys, Michael here. No message from any listener today, except mine. Me and my boyfriend have a message for y'all. Just promise not to laugh, okay?
well, hello, Michael.
Hey, Michael. And the boyfriend.
We absolutely love it when you check in.
Yes, thank you for joining us.
Okay, what is the message?
We are all ears.
No,
Well,
actually...
while you're thinking about it, we're talking about market microstructure.
And we are focusing on how
Oh, go
Hey
for it.
guys. Okay, no, actually, I'm just gonna read it later. You guys just continue the conversation.
No problem at all, Michael.
We totally get it.
You can drop that message in the chat whenever.
We love hearing from you and your boyfriend, so don't be shy later on.
Just jump in. We are flexible.
But in the meantime, we will keep the show moving.
Yeah, let's keep going.
Okay, let's unpack this. We were about to talk about the 5 Vs.
The essential building blocks.
I like to think of them as the 5 Vs of a perfect drag look, honey.
You need to nail all 5.
Because your basic traditional economic models,
They just can't handle this gig.
they really can't. The scale and the speed today.
It just makes all those old techniques totally obsolete,
And we are focusing on how Python deals with it.
especially the data quality issues.
Right. And, we're covering everything from basic finance principles
Like debits and credits,
to things like the Financial Information Exchange Protocol.
the FixIX protocol.
That's how messages related to securities transactions are sent.
It's all about real-time transmission.
So we're crossing that bridge from academic materials to the real-world financial market.
It's a great journey.
We're excited to hear that message when you're ready.
But in the meantime, we'll dive into the 5 Vs.
They dictate everything from Wall Street to, what's happening on your phone.
All right, let's start with the first V, volume.
She is large and in charge.
Yes, we're talking petabytes of information.
Raw logs, every single click, tick-by-tick market data.
All the receipts.
All of them. And your little laptop is going to choke instantly.
To handle this kind of volume, you need distributed systems like Hadoop's DFS.
It's the only way. Okay, so volume is the foundation. What's next?
Variety. The data doesn't just show up in a neat little spreadsheet anymore.
It's not giving clean lines. It's messy.
It's so messy. You've got news articles, social media feeds, video, even satellite images.
So to analyze that kind of variety, you need a whole new toolkit in Python, like natural language processing.
Got it. Now for the V that keeps me up at night staring at the ceiling.
Veracity, the trust issues.
So many trust issues. Is this data for real? Is it clean? Is it even relevant?
It's like, is this guy on Hinge really a 6'4" doctor, or is he 5'9" and sells crypto to his cousin?
You have to verify.
And in finance, if your data is lying to you, your model is worthless.
It could be worse than worthless. It could be catastrophic.
Okay, next up, velocity. She's fast.
Very fast. In high-frequency trading, we're talking milliseconds. The data is flying.
So you need these incredibly rapid data pipelines to slice it and process it in like near real time.
And finally, the whole point of the gig, value.
Yes, the grand prize. All these other V's mean nothing if you can't generate some kind of actionable insight from them.
It has to make money or reduce risk.
And this is key. It has to be interpretable.
The stakeholders, the regulators, they have to understand what the hell your model's trying to say.
Right. It can't just be a black box serving a look with no explanation.
Exactly. You have to be able to explain the look.
Now, to get started, you need the technical foundation. Where do we even get this data?
Well, you run into a big difference right away. You've got your free sites like Yahoo Finance.
They're fine for, basic end-of-day data.
It's the fast fashion of data. It's cute, it'll do for a night, but it's not couture.
Perfect analogy. Because if you want the full look, the deep market microstructure, every bid, every asker, you have to go to the exchanges or the big data vendors.
And that's where the formats get complicated.
They get very complicated. You might get a simple CSV file, which, Python and Pandas can handle easily.
But in the pros, you're dealing with much more complex protocols.
Tell me about the big one, the legend.
That would be the FIX protocol, the Financial Information Exchange Protocol.
It's the industry standard for high-speed electronic communication.
Okay, so it looks intimidating, like a bunch of tags and values.
Why can't Python just read it like a text file?
Because it's not a file, it's a dialogue. It's a constant session-based conversation between two parties.
You need specialized libraries, like Quick Fix, to manage the whole session.
The logins, the handshakes, the message sequencing.
So it's a whole relationship you have to manage, not just a one-night data stand.
Precisely. Knowing if you're dealing in a simple CSV or a complex fixed stream completely changes how you prepare your entire pipeline.
Okay, this is critical. So here's our promise to you today.
This deep dive is going to reveal all the Python secrets for managing this financial chaos.
We're going to teach you how to read short interest like a shady X's texts and how to use data quality like a perfect face contour.
You're about to become a very, very informed analyst.
Let's get into the source material.
Okay, so to get started, we need a reliable source, the bedrock, and that's government data.
And Python gives us this amazing seamless access through APIs.
The big one is the FRED API from the Federal Reserve.
It gives you instant access to hundreds of thousands of economic time series.
GDP, inflation, interest rates, all the big stuff.
Right. You need that macro data to set the scene. It's the context for all the drama that's about to unfold.
Let's get specific, though. What's a really good visual piece of data we can pull with Python?
The perfect example is the constant maturity treasury yield curve, the CMT curve.
Okay, she sounds important.
She is. It's not just a line graph of prices.
It's a snapshot of U.S. Treasury yields from 1 month all the way out to 30 years on a specific day.
And crucially, it's calculated using closing market bid yields.
Wait, hold on. The bid yields, the price people are willing to pay, not what they actually paid. Why?
Doesn't that make it a little subjective, a little shady?
That is a great question, and it's because the Fed wants to capture market expectation and demand, not just transaction volume.
They use an interpolation process across all outstanding securities to create this smooth theoretical curve.
It's a standardized measure of sentiment.
Ah, I see. It's the vibe of the market, not just the hookups that actually happen.
Exactly. And with Python, using pandas and matplotlib, we can visualize this curve over time and spot these huge macro trends immediately.
So what kind of trends are we looking for? What's the T from the yield curve?
Well, the shifts are profound. You can plot the curve over time and see these major changes in interest rate expectations.
For example, look at the bull flattening from 2010 to 2012.
Bull flattening. Okay, break that down for me.
It's when the long end yields, like the 10-year, 30-year fall, faster than the short end yields, the curve gets flatter.
It usually signals that the market thinks the economy is slowing down and long-term inflation is dropping.
Got it. And what's the opposite?
That would be something like the bear flattening we saw from 2004 to 2006.
That's when the short end rises really fast, usually because the Fed is hiking rates aggressively to fight inflation.
The curve gets compressed from the front.
And this is where we get the big recession indicator, right? The inversion.
Yes. When the curve inverts, when short-term rates are higher than long-term rates, it has historically been a very reliable predictor of a recession about 6 to 18 months out.
And with a simple Python function, you can calculate that 10-year minus 2-year spread and plot it.
The signal just pops right
I
out.
love that. Turning data into prophecy.
Okay, so we've got our government foundation. Now let's get messy. Let's talk alternative data.
This is where we start listening to the gossip.
This is where we get into the really unconventional stuff that can give you an edge.
And Python is, again, the key tool here with libraries like PyTrends that let you programmatically access the Google Trends API.
So we're literally checking what people are Google. Are they searching for Apple, for Tesla?
Because a big spike in search volume can be a leading indicator, especially for retail traders.
It can be. And we can go even deeper. We can scrape social media like YouTube comments or Reddit threads.
And this is the data prep is a nightmare.
Oh, I can imagine. It's a mess of emojis and typos.
Exactly. You have to do so much cleaning.
You use Python's NLP toolkits to do tokenization, breaking it all into words and stemming, which is reducing words to their root form.
So your model sees crash, crashing, and crashed as the same idea.
And you have to be so specific with your keywords. If you're looking at crypto, you can't just search crypto.
You need Ethereum, proof of stake, gas fees, all the nerdy details.
You have to be surgical. And the sources point out you should also weight the data.
You can count likes or replies. A really controversial comment that gets a ton of engagement should probably carry more weight in your model than something nobody interacts with.
So this was all used to create the Google Trends Cryptocurrency Index, the GTC.
What did they find? Is Google driving Bitcoin or is Bitcoin driving Google?
That's the fascinating part. The information flows both ways, but it is not symmetric.
The research found that significantly more information leaks from Bitcoin's return and volatility to the GTC index than the other way around.
Whoa, so a big dramatic price swing in Bitcoin makes people run to Google.
The search volume isn't causing the drama. The drama is causing the search volume.
Exactly. The market action, especially high volatility, generates public curiosity.
Analysts might see a spike in Google Trends and think it's a leading indicator, but it's actually a lagging signal of human reaction.
The shade of it all, that is a critical distinction.
And it brings us perfectly to data quality, the veracity check we mentioned earlier. Time to check the receipt.
Since we can't always trust the chatter, we have to scrutinize the data itself. Every database has trust issue.
Let's talk about the specific biases, the skeletons in the closet. What's survivorship bias?
That's when a database only includes the winners, the companies or funds that survived over the study period.
It completely ignores all the ones that failed and were delisted.
So it's like only looking at your successful relationships and pretending all those disastrous first dates never happened.
It gives you a completely unrealistic view of your dating performance.
That's a perfect analogy. It makes your results look way better than they actually are. Then you have backfill bias.
Ooh, she sounds sneaky.
She is. That's when a vendor adds a company to an index, like the S&P 500, and then retroactively adds all its amazing historical data.
So when you run a backtest, it looks like you picked a winner from the very beginning.
But you wouldn't have known. That's cheating. That's financial time travel.
It's pure look-ahead bias, using information that wasn't available at the time of the decision.
Python helps prevent this because you have to be so strict with your time series data, making sure the future never leaks into your past data.
Okay, beyond these big systemic biases, are there just simple mistakes?
Oh, constantly. Stock splits, mergers, these things are complicated, and databases often record them differently, even within the same database.
Give me a number. How bad is it?
The source material has a staggering one. A study of the IBES database, which tracks analyst earnings estimates, found that the analyst estimate differed from the actual reported number 39% of the time.
39%. That's basically a coin flip. Why?
It could be different definitions. Maybe the analyst used operating earnings and the company reported GAAP earnings.
But that lack of standardization is a huge problem you have to account for.
Okay, so with all this lying and cheating, we need a lie detector. Enter Benford's Law.
Yes. Benford's Law is a statistical tool that's basically a lie detector for numbers.
It's based on this weirdly consistent observation about naturally occurring data sets.
Which is?
That the first digit isn't random. The number 1 appears as the leading digit about 30% of the time.
Then 2 is next, and so on, with 9 being the least common at less than 5%.
That feels so random. Why does that happen?
It has to do with logarithmic scaling. Things that grow proportionally like revenue, stock prices, populations, tend to follow this pattern.
But if people are just making up numbers or rounding up to hit a target, their fake data will have way too many high digits, like 8s and 9s.
It won't fit the Benford curve.
So you can literally spot the fraud. The source material said they used this on banks during the financial crisis, right?
They did. They focused on the distressed banks, the ones that failed or got bailed out.
And they found that their financial statements, both before and after the crisis, showed huge deviations from Benford's Law.
They were cooking the books.
It strongly suggested manipulation, especially in things like loan values and total assets.
It's an incredibly powerful tool that Python can automate to scan thousands of reports for signs of drama.
All right, so we've got our data, we've checked it for lies. Now we need to actually analyze performance.
And first, we have to define our returns.
Okay, there are two main flavors, right? Simple and log.
Percentage returns, or simple returns, are the intuitive ones. My stock went up 5%. Easy.
They're additive across the portfolio, which is nice.
But they have issues. They're not a good look for serious modeling.
They're not. They're not additive over time, for one. And they're bounded. The worst you can do is negative 100%.
That asymmetry messes with a lot of statistical models.
Which is why all the serious quants use log returns.
Log returns, or continuously compounded returns, are the engine of quantitative finance.
They're symmetric, so a 10% gain and a 10% loss have the same magnitude.
And crucially, they are additive over time.
You can just sum up daily log returns to get the annual return.
And that symmetry is what the algorithms and Python libraries crave, right?
Yes, exactly. They approximate a normal distribution much better, which is essential for things like value at risk or portfolio optimization.
If you're doing heavy-duty modeling, you have to use log returns.
And no matter which one you use, you have to annualize them to compare apples to apples.
Right. And for percent returns, you have to use the geometric mean to correctly account for compounding.
Just taking a simple average will make your returns look better than they actually were.
Okay, so we can measure performance. Now we have to measure the risk.
It's time to talk volatility. Time to manage the drama.
Volatility is...
Yep, go on.
Hey, so can I read the message now?
Please, yes. We would absolutely love that.
Anytime, Michael. We were so curious. Oh, go for it.
So, sorry to disturb your flow.
Ed, we can definitely pause the drama for a second.
We were just about to dive into volatility, but we can absolutely wait.
So what's the message from you and your boyfriend? Oh yeah, let's hear it.
So, okay, I just had to.
Yes, Michael, take your time. Oh yeah, go on.
Okay, so my boyfriend Emmanuel and I have finally figured out how to optimize our portfolio performance. Usually I'm the one handling the hard-coded assets, but last night I was struggling with a particularly thick piece of Python code. I was trying to run a Monte Carlo simulation, but my backend kept crashing. I told Emmanuel I was having trouble with my indentation, and honey, he did not disappoint. He took one look at my source code and told me I was being way too loosely typed. Before I knew it, he was performing a deep dive audit of my local variables. He really knows how to handle a long format data frame. And let's just say his penetration testing was extremely thorough. He didn't just debug my script, he stayed up all night ensuring my liquidity was properly managed. By the time we reached the climax of our trade,
Well, Michael, that is a...
Oh, yeah,
yeah, okay, my volatility was through the roof. I haven't seen a spread that wide since the 2008 crash. It turns out that when you apply enough friction to the moving averages, you get a very high rate of return. We're now officially deep in the money, and my PIP has never been more satisfied with an installation. Anyway, Emmanuel wanted to wish you all a very belated Happy Hanukkah. He texted me to say, "May your candles stay lit and your oil reserves stay longer than Michael did last night. Shalom." Did he just call you guys fracking queens? The shade.
Michael, that is next level, honey.
Wow, thank you for sharing all of that.
That is fantastic. We appreciate both of you tuning in.
And that message from Emmanuel, that is hilarious.
Very creative use of financial terminology.
We appreciate the belated Hanukkah wishes. Thank you.
And we are definitely staying lit. We love the shade.
And let's address your technical success.
That portfolio performance optimization sounds incredible.
You mentioned friction and moving averages.
Okay, let's unpack it. That's technical analysis.
Applying friction or reducing it to moving averages is a key strategy.
A crossover strategy to sell a stock happens when the current price falls below a moving average,
So reducing that friction can indeed tighten spreads.
which means more volume can go through the pipes.
And tighter spreads mean a lower transaction cost for you.
It's all about execution and market efficiency.
We noted earlier that market spreads are tighter now than ever before.
And when you're deep in the money, that means your trade is highly profitable.
That is a wonderful outcome.
And your personal volatility being through the roof, that tracks.
High volatility often results in substantial surge in short-term price volatility.
You definitely felt the market drama in real time.
So you manage the risk, you hit the return, and you're deep in the money.
That's collaboration, honey. We love that.
That spirit of optimization is a perfect fit for where we are.
Because in finance, you want your assets to collaborate, not collide.
We need that collaborative spirit to extend to our portfolio.
We were just about to dive into volatility more formally.
Which is all about managing risk, which you just successfully did.
You already know that volatility is the dispersion of returns,
And the most common way to measure it is standard deviation.
which gives us an idea of the risk.
But we have to go deeper than just standard deviation.
It's not enough to just look at the overall risk.
You need to understand how volatility changes throughout the day.
That's intraday volatility, right?
Precisely. The sources show that volatility surges at market open.
Like the first hour of trading, it's high drama.
Yes, and then it tends to drop off midday,
Everyone goes to lunch.
but it spikes again right before the close.
So Python models need to account for this time-dependent risk.
And you brought up the 2008 crash.
That's a classic example of volatility surging.
In that case, the violent market fluctuations were driven by conflicting news.
It added to that substantial surge in short-term price volatility.
So how do quants measure volatility when the data is ticking by so fast?
We used to realize volatility measures.
This is where we get into the really granular data.
We're talking tick-by-tick returns.
You can't just use end-of-day prices anymore.
You need every single transaction price.
One method is the realized kernel.
It sounds complicated. Explain it simply.
It's a way to estimate volatility using high-frequency data.
And it helps filter out market noise.
Yes, it deals with microstructure noise like bid-ask bounce.
Because price moves can sometimes be noisy, not true volatility.
The realized kernel finds the true underlying volatility signal.
And Python lets you implement these calculations easily.
Another measure is value at risk, or VAR.
Now she's a diva. She tells you the potential worst-case loss
It estimates the maximum amount of money a portfolio could lose.
over a specific time period and with a given probability.
For example, a one-day 99% VAR of $1 million.
Means there's only a 1% chance you'll lose more than that in a day.
It's a key metric for regulators and risk managers.
You can't run a Monte Carlo simulation without it, Michael.
Which loops back to your earlier point about Monte Carlo.
Now let's talk about diversifying your portfolio.
You're managing risk, but how do you maximize returns?
You look for low or negative correlation between your assets.
That's the power of diversification.
If one asset drops, the other is likely to hold steady or rise.
It makes the combination less risky than the individual parts.
We call a correlation of -1 a perfect hedge.
Though a perfect hedge isn't always desirable.
It wipes out the risk, but also any chance of a profit.
You need that slight bit of risk for the reward.
You have to find that sweet spot between risk and return.
And that's exactly what portfolio optimization algorithms do.
They use Python to calculate the optimal weights for your assets.
Finding the highest return for the amount of risk you are willing to take.
All right, before we wrap up, let's talk about one more key metric.
Something that incorporates both risk and return.
The Sharpe ratio.
Is the queen of performance measurements.
It measures the excess return per unit of total risk.
A higher Sharpe ratio means you're getting paid more for the risk you're taking.
It's how you compare two different investment strategies.
We've covered a huge amount of ground today.
From the 5 V's of data to realized volatility and the Sharpe ratio.
And we especially enjoyed the update from you and Emmanuel.
Thank you so much for joining us for the deep dive.
Keep coding, keep optimizing, and stay lit.
Ciao for now.